And that's a beautiful, beautiful segue then into this discussion around some of these potential infrastructures for coordinating both data but also behaviors around incentives. And to speak to some of that, I'm really glad to have both Robert O'Brien, who shared a beautiful set of discussion threads in the session notes, if we want to switch over to session 4 notes now. And I'm going to be asking Robert just to kick us off with some of that context setting around some of the work he's been doing around multiple value accounting systems that I think you and Martine in particular will have a good jam going forwards. And I'm also really happy to have Catherine Gu, who's going to be sharing with us some of her work from a technical perspective around governance of stablecoins and digital currencies. And I think, again, from the perspective of this intersection of law, technology, policy, this is this, I think, broader set of capabilities that, again, was referred to in the last session around the adaptability and the responsiveness. And I think as on a broader sense, we're looking at the ways in which these larger accounting systems are closing these gaps. I think closing that gap between the legal systems and the technical infrastructure so that they are mapping and they are both of them aligned to our underlying human value goals will be, as they develop, will be really interesting. We did have a couple of additional speakers who unfortunately had to drop out, but I will in this session also be looking to Robert Green as well as Brian Tang, who both have a lot of background in thinking about the regulation of digital currencies. And again, anybody else who wants to jump in at any point, please pop a question in Slack and we'll go from there. But first off, Robert O'Brien, thank you so much for staying up to join us. He's beaming in all the way from New Zealand. I mentioned at the beginning of this overall set of working sessions that we'll hope to be following these up with some sessions which are more amenable to European and Asia Pacific time zones. But Robert, for staying up into the middle of the night and joining us all the way from Aotearoa. Thank you so much. Robert is one of the friends that I made through the Legal Hackers community. Legal Hackers is a global community of lawyers, technologists, and policymakers who gather together in local chapters in a very decentralized way to try and push things forward at that intersection. And Robert is the co-organizer of the New Zealand Legal Hackers. But on top of that, he's also had a long background in distributed finance, again, coming from that programming side, but has a lot of deep insights and thinking from the, I'd say, the policy and the philosophical angle as well. So with that, Robert, potentially I could ask you just to set some context for us about this broader issue.
Okay, I take it you can all hear me. I just wanted to make sure it's okay, yeah? Right, yeah, I haven't stayed up late, I got up early, so it's only a few hours extra early for me, so that's not too bad, and it's just, the sun's just starting to rise. What I wanted to do is, the initial stuff that Martine was talking about really kind of encapsulates a lot of the things that I'm thinking about at the moment and looking into. I come from a perspective of how do I engineer these systems, these technical systems? And so obviously for me, the question more is, I get involved in a whole lot of other areas because I'm trying to actually understand from more or less from an ethical standpoint, socio-technical systems, how these systems are playing in society. So what are the design implications? What are the requirements that they should or shouldn't do? I think for a lot of software engineers or software developers, the ethical questions are actually something that's not never really fully considered, but has been sort of brought up more recently in light of all the Facebook issues around the use of data, etc. So from the ethical standpoint, where I first actually got involved in the sort of work that I'm doing now was really looking at it from an identity and privacy standpoint. And what I was really trying to ask a question was, is how can I design trustworthy digital systems? And digital identity always rears its head a lot. And the flip side of that is privacy related concerns. But in working into this, I came to a very sort of weird conclusion, which, and this is going back sort of like mid-2000s, 2005, 2006 sort of period, was that actually money and finance more generally had quite an important role to play in how we build trustworthy systems. And this made me sort of question a lot of the work that I had done prior, which was in the financial sector, building trading systems, pricing engines, doing data analytics, etc., mainly for derivative-based sort of products. I started looking more into sort of like community currencies. I'd already been familiar with a lot of the material around financial cryptography, indeed all the sort of work that now people are becoming aware of with all the blockchain sort of stuff. So more recently going forward, I started working with a colleague who had been involved building effectively a social investment approach for the New Zealand government. So what I'll do here in context setting is just, let's just assume everything that Martin was talking about is the sort of thing that I've been looking at. So I'll just try and provide a little bit more context, the New Zealand context and the perspective that I bring to a lot of this work. As you may or may not know, New Zealand's a small island nation of about 5 million people. We have a benefit of a huge moat around us called the Pacific and Tasman Ocean. We're a long way from everyone else, which also means with respect to the current pandemic, as far as I'm aware, we're the only country that's actually trying to eliminate it rather than just deal with it. That is certainly the goals. We're, like many other countries, in lockdown at the moment. Another benefit too is we can feed ourselves. We're a net exporter of food, and the bulk of our energy production is sustainable. Most of it's hydro and wind, etc. I think about 95, 96% of all energy from an electricity standpoint is actually all sustainable already. And we have a very unique bioheritage background. Largely, it's a country that used to be all birds. There was no mammals until humans introduced them. And thirdly, we have a finally, a sort of a kind of relationship, kind of a dual governance model between Indigenous and the more British sort of colony type of structure going on. So that's manifested through something called the Treaty of Waitangi, which was a shared governance model between the British Crown and Māori in about 150, 60 years ago. That's still very prevalent to us in New Zealand. And that's quite unique because in a sense, we've got strong representation from Indigenous culture, of which I am a New Zealand Māori, and its concepts of we, and I'll bring that in a moment, versus the more sort of Western notions of I, or me sort of situation. So we've got this kind of dynamic going on between the we, which is very holistic in its treatment of things, and the me, which is very individualistic. As a result of that, there's always sort of constant tensions and etc. going on, but there's some really unique things coming out of that. One is that Māori significantly place a huge importance on the natural environment. Massive importance is the natural environment. It recognizes very clearly that we exist in the environment and we can't exist without it. Such that many of the large land features in our country are recognized as ancestors. They're personified as individuals. Mountains, of which I descend from Taranaki, and rivers and forests, etc., these days are actually given legal status, personhood legal status. And we have this notion of kaitiaki, which is guardianship over them. So we've got to respect them. And that's actually, as I said, part of law. So many of the government agencies, in particular, must take these factors into account. And as a result, we've more recently had quite a bit of work being done across this idea of multiple capital accounting, which is more of a holistic way of looking at a complex society or complex environment and trying to measure those sort of things accordingly and set budgets for them. As a result of 2019, we had the first sort of well-being budget that came through, which is actually a first attempt, and I think actually first attempt internationally, to try and codify these accounting principles into government agency work and their budgeting requirements, etc. Within that context, the work in the last 4 or 5 years has been around what started off as the Social Investment Agency. It was an initiative driven by our then Prime Minister to look at how to do investment into social policy payments, etc. It is now, the agency itself is now renamed as the Social Wellbeing Agency, so you get this idea of wholeness and well-beingness being incorporated, and this factors heavily into the notions of environmental sustainability and governance sort of factors coming through. So all the ESG side of things, and obviously the SDGs. So the work we were doing out of the Social Investment Agency was how can we use data to inform policy-based decisions, and more specifically, investment-based decisions into moving decision-making and moving funding to the edge, moving into local communities, etc., allowing those local communities. And a good example of this are the iwi or tribal associations that there are numerous around the country that carry a lot of work to do with their rohi, their area or group. And move that decision-making and allocative function closer to the edge. And in order to do that, it needed to have data. However, most of the data here government agencies were dealing with, because of the Privacy Act and laws, meant you couldn't share things around between agencies for obvious reasons. So most of the data coming through was aggregate, and didn't enable sort of the point-wise sort of investment and feedback loops that were necessary to really target social investment properly. So this is the sort of pay-by results or kind of models of social bonds, etc., going through. So what we did within the New Zealand Data Commons was take the work and say, well, can actually we turn this around in twofold? One, put control over a person's data back into the hands of the individuals or the groups. But more importantly, and this speaks to the topic of this session, was how could we redistribute the value that was being created through this, and whatever we meant by value. So we're not talking specifically about monetary value here, but more generally, how can we spread value around and make sure it was redistributed accordingly. So that was the work on the New Zealand Data Commons, which was taking an institutional lens through it. So it's a new institutional economics lens. So bringing in the work of Eleanor Ostrom, Ronald Coase, Donald North, and even Hayek's sort of notions around knowledge and society and those sort of things, to try and bring back a form of market-based mechanisms for social impact investing, and using that data to drive that. That sort of work has led on to something called toha, which is basically means to redistribute in Māori, which is basically looking at using distributed ledgers and work, and specifically a type of thing called a augmented bonding curve to actually enable social investment at the edge. So much finer grain sort of edge investment approach to look at funding impact, or what was referred to as impact organisations. which is largely trying to say, if we could get a lot of the grassroots sort of work to account and report on their activity, the impact that they were having, feed that back into the investment approach, would then could enable more targeted investment. So eventually building up into sort of like things like a portfolio approach to investment, and even in principle, you could extend up to EFTs, electronic traded funds. Now, so that's a way of financing directly into as close to the edge as possible and making that accountable. More recently, I've been looking, because one of the big challenges within that area is how do you compare apples and oranges. One of the big problems with doing things like social investment, etc., is that you can't specifically compare one investment with another. So because they may be in totally unrelated areas. And this applies both from a climate standpoint that Martin was talking about, and also sort of social and equality standpoints, is that in order to be able to invest in these things, you have to be able to compare two quite different types of investment propositions and compare them and make a decision of what's actually going on. So this has been well done within typical financial capital. We do that all the time. That's what a lot of all the financial reporting, prospectuses, etc., are doing, is an attempt to both deal with the principal agent problem, so get fair reporting that's going on, but also to be able to compare two completely different investments in two completely different industries and know whether you're getting the same sort of returns, etc. So could we apply the same sort of idea of reporting and data feedback coming through to into the ESG domain? The primary purpose here is that a lot of the ESG sort of reporting and stuff is still currently narrative based. So how can we actually make it more quantifiable and therefore comparable? And within that light, that's where I've been looking into the work around what is known as multi-dimensional accounting. So this is basically providing a mathematical formalism to accounting, which might sound strange, but it doesn't actually have one. This is looking at work of David Elderman, who sort of was looking into this area, but a few others as well, which is basically how can we use mathematical tools to help us do double entry accounting, and therefore bring the complexity of the environment into sort of the technical space to enable us to do accounting in different forms. And what's important here, the lens that I take here, is that currencies, in terms of just pure digital currencies, are a standardized unit of account. Whereas when we actually look at any of the accounting systems, and particularly the operational systems like SAP and things like that, accounting is the professional normative practice of basically doing value measurement. And so largely that is the process of recording events, then classifying them into some sort of account, which you could call a currency, and then reporting over that to try and make decisions and inform what's actually going on. So one of the benefits of, or one of the ways of looking at this is that essentially you can take a chart of accounts and treat that as a type of currency. Now that then enables it to be easily represented in terms of things as blockchain-based systems, different mechanism designs, etc., that are going on, as well as sort of incorporating that within business processes. And with that, I'll sort of, that's a sort of long rambling sort of chat of the sort of things, some of the sort of things that I've been looking into.
Robert, thank you so much for laying that out. You dove into a number of things, and I saw Martin just popped himself back on the video because I think there's a lot that he wants to jump in with. But before you do, Martin, if I may just let Catherine come in and sort of potentially lay out some of the work that she's been doing around maybe some of these implementations of mathematical models around mechanism design. I saw that there's been a little flurry of discussion around bonding curves when you mentioned that, Robert. Bonding curves came up as a flash in Evan Absher's head. Evan's joining us from the Kaufman Foundation, but I know that in terms of algorithmically thinking about these value distributions, that's something that Catherine has been doing a lot of research on. So Catherine, if I could give you the spotlight now, and if you could share with us some of the work that you've been doing around governance of these technical systems as well. Catherine.
Okay, great. Thanks, Tony. You guys can hear me, right?
Yes.
Okay, awesome. So I'm still at Stanford, and I've been doing a lot of research with Professor Dan Benet from the CS department. And I think a lot of you might have heard of him before. He is the one who designed the BLS signature, for example, in the cryptography world, and it's been pretty much commonly used in around the community right now. And that's kind of focused on privacy side. But what I've been mostly interested is in the side of the stablecoin, both from like a decentralized perspective, but more often these days, I'm looking into the whole central bank digital currency as well. Dan, me, and another student, we actually wrote a paper that is now accepted by the MIT's Crypto Economics Conference. And the thing that we looked at is through empirical measurements to really look at the algorithmic design of stablecoin, in particular, the aspect to do with the Oracle problem. Oracle problem is only a very minor part of the entire design of stablecoins. And I think there's a lot of very interesting, I guess, intricacies into the design of anything which is now algorithmically driven. And I think one of the key highlights to mention is that despite this whole world of decentralization in a trustless system, you know, like where everything is pretty much written in codes, like the most important thing to recognize is actually there's a huge amount of human factor that goes into it. So take an example of the paper that we looked at. In particular, we were looking at this protocol called MakerDAO. So MakerDAO is the biggest stablecoin project out there right now in the whole decentralized world. And at the moment, I think it has about over 300 million Ethereum locked in that protocol, which is controlling over like 57% of the whole decentralized finance universe in general. So it is one of the biggest. And it also has the, and it also has the longest history in terms of the data that we can get. So what we did is to actually go into the Solidity contracts and look at the code, how it's being written, and then compare the sort of the Oracle reporting quality of the prices that is being produced on-chain through the MakerDAO's protocol versus what we observe off-chain. That is the sort of benchmark you would look at, say, from Coinbase or from Gemini or from CryptoCompare and those sort of benchmarks out there. And Oracle problem, let me just sort of give like a very brief sort of description in terms of what it is really about, because it's essentially asking the question, how can a blockchain learn about things that is happening outside of that sphere? So you can imagine on MakerDAO system, all the things that it can observe is in terms of how much DAI is being printed and, you know, the circulation and stuff like that. But what is very interesting for the protocol itself to know is, for example, is the price of collateral assets that's being staked as part of the stablecoin projects. And for that price reporting to happen, it has to happen to get the source, which is off-chain from the other part of the world, and then being fed on-chain to the crypto native MakerDAO system. And during this process, there would be a lot of human factors that goes into the decision making. For example, MakerDAO, through its governance process, which is kind of a decentralized process overall, it selects originally 14 anonymous price feeds who then feed prices on-chain to the Maker's protocol. And there's also other requirements that's being asked by each of these anonymous price feed in terms of the price quality, how long it could be valid for to be used in terms of computation and so on. So those are all the intricacies that's involved in terms of just writing that Solidity code and being run as a smart contract. However, what is very interesting is that even though, you know, the code is saying some certain things, but through certain sort of different human designs, it can have a lot of different impacts. So what we noticed, for example, one of the really interesting thing just happening on MakerDAO is that Maker claims they introduced this thing which is called a 6-hour rule. And what that means is for any price that's being reported to the Oracle, it should be valid for only up to 6 hours. And then after that, it shouldn't be used as the computation of the price of Ethereum. And I'm happy to go into more into that, but essentially the 6-hour rule, what we observe is in reality is broken, and it is broken because people can manipulate the code, and it's actually because part of the code is as part of the input parameter as opposed to something hard coded in the contract. That's why it can be manipulated, and this is part of like a really good example in terms of how you can think about incentive compatible mechanism design in general, because I guess the point is all the details are hugely important in terms of whether people will eventually behave in the way that the protocol itself wants to behave, especially in a world which is trustless. You don't have the legal recourse to actually say, well, because you did something wrong, you should be, you know, held accountable for certain things and so on. So these are the things that we have been detected through our empirical measurements. And in fact, just to give you a concrete example, back in 2018, when MakerDAO was first launched, the biggest divergence in terms of what the price of Ethereum you observe on-chain on the MakerDAO system versus the Ethereum price you can observe off-chain, say on Coinbase, the biggest divergence happens around to about $150. So you can imagine this is a huge scale. When the Ethereum price can diverge by $150, that could represent about like 50% of price deviation between those two. And when those things happen, the immediate economic implication is for smart, say, algorithmic bots or smart trader out there, they can immediately take advantage of a price arbitrage like that and to make a profit from that mistake. So to, you know, if you call it that way, to make a profit from that. And it does happen in real life, even though not on MakerDAO system. It happened in the summer last year on one of the other sort of DeFi project called Synthetics, where over $37 million has been stolen because there's clever bots out there who can really take advantage of the sort of deficiencies in terms of this whole technological implementation of codes and stuff into the stablecoin and really trying to gain from that system. So I guess the point is, you know, there's a lot of things that we think algorithmic design is very great and, you know, it's trustworthy and stuff, but I think the really important thing is to really look deeper into exactly how those codes are written and whether they're incentive compatible or not. And MakerDAO is such an interesting protocol. That's why we really keep a close eye on it. And as I said, it really controls over 50% of the entire DeFi. So it's hugely important in terms of the future health of this entire decentralized finance world. That's why MakerDAO is like is playing a pivotal role. And to Maker's credit, in its version 2, it definitely addressed a lot of the problem that happened and the things that we detected in version 1. So for example, things like prices were being stable and it was used more than 6 hours and it's still used in the computation of the median price of Ethereum and so on. Those things have all been addressed. But I think, I don't know if you guys have followed, but basically during the middle of March, when all the traditional finance market has crashed massively, and so did the crypto universe as well. So Bitcoin has tanked by over 50%, similarly with Ethereum and so on. And actually during that moment on March 12th or 13th, MakerDAO almost went bankrupt because there was some problem with the gas price being spiked up so high, and a lot of the under collateralized debt was sold off at almost $0. So it was a huge impact on the entire community. And through that experience, again, it just says, okay, when we have like a black swan event, or something that is hugely stressful to the entire ecosystem, those so-called algorithmic designed system might not be entirely trustworthy. And that's why you still need the human factor to come in and to rescue the system. Maybe you need to hold the system for like 1 or 2 hours to fix things. And this is what happened on BitMEX actually on the exchange. And maybe you need better governance design in terms of thinking the potential loopholes that's out there where you know, during times of stress where things could happen. So this is the sort of the general landscape in terms of those decentralized projects out there. And I think it's really worth mentioning that at the moment, especially like the whole stablecoin universe is hugely popular in around 2019, and there were over 200 projects out there. And I think it's really worth mentioning from more like a contrarian perspective, we don't need that many projects. In fact, we probably just need 5 of them, and that should be enough. Why? Because I say that if you look at the traditional world out there, we only have major currencies which is denominated in dollar, in sterling, in euro, and possibly Chinese yuan. And that's all we need. And in terms of the thinking about why we are designing stablecoin in the first place, I think one of the key motivation that we should always hold in our mind is, well, what is the purpose? Who are we trying to serve? What is the exact objective of creating that stablecoin in the first place? If it's just trying to create something for the sake of just being another stablecoin out there, well, it's not going to succeed. And that's exactly what you see in terms of like what happened through 2019 and until now. There's a lot of projects that just went out because it just simply cannot gain that network effect that you need in terms of having a stablecoin to succeed. Because kind of going back to the purpose of what is money in the first place, money is used as a medium of exchange. And if no one or not enough people are using it as a medium of exchange, then there's no point of having a stablecoin as such. And I think just to sort of wrap up what I'm talking about, again, focusing on the technical side, I think the emergence of central bank digital currency is extremely interesting, and this is definitely something I think for the community right now should focus a lot of attention on. And it's actually interesting because I think because of the coronavirus and all the things that's happening right now, it's actually accelerating the speed of CBDC to be introduced in around the world. Some of you might have already seen that in the Virus Act, in the draft version that was put into Congress. It was very shocking, and it was done 2 weeks ago. The notion of digital dollar and the use of digital wallet was introduced starting from page 4, and they talked about for the next 5 pages in terms of how we can use digital dollar and to directly distribute money to all these individuals as part of the stimulus package. Actually, the day after, in the official proposal that they put on for Congress to vote on, the part about the whole digital dollar and stuff was being removed. And I guess it's because the technology was not there yet. But it is a very clear indication, at least from the Federal Reserve and from the US side, you can see that people are taking extremely seriously, and there's a real need for CBDC. I suppose before the onset of coronavirus, a lot of people are thinking, why do we need CBDC in the first place? Don't we already have all these digital forms and so on? Well, to make a distinction, the sort of digital things that you have through Venmo or through like Zeller or other sort of like interbank payments and stuff like that, those are digital money, but for commercial bank deposits. But what is introducing now is in terms of having a direct digital form of central bank money, that people like us, normal people, have never had access directly to central bank money. And central bank money is very different from the commercial bank money in the sense that central bank has the power to unlimitedly like printing out more money, and therefore there is just more trust and security that you can put into the central bank as opposed to what you can put into commercial bank. And with the whole coronavirus and stuff like that, well, there's 2 things I think that is really relevant in terms of why CBDC now makes more sense than before. Well, first is in terms of this notion of, say, universal basic income or other kind of stimulus incentive driven purpose, that the government in a way want to directly interact with the population, trying to quickly bring back the economy to a more or less normal level, so that, you know, I can directly give you the money, as opposed to I first reduce my bank rates and then influence the commercial bank, and through commercial bank you then have this chains of multiplier effect that will eventually feed into the economy, which is roughly going to be at least 1 or 2 years time, as we know through these sort of traditional economic analysis. So number 1 is about the economy. Number 2, I think, is actually to do with the fact that a lot of central banks now realize there's a need for a new type of monetary instrument to be introduced on top of the interest rate that they're already using. And the reason why we're saying that is actually because in all these developed countries, as well as countries that you see in China, most central banks are already running at a near zero interest rate already. So in a way, they're running out of ammunitions in terms of how to really rejuvenate the entire ecosystem. And they realize with the introduction of a CBDC or new type of assets, there's a lot of extra activities you can help to boost the economy, and it actually helps to alleviate the pressure in terms of having a near zero or negative interest rate. And that's why I think from both a societal perspective, but also from a policymaker's monetary perspective, the CBDC notion is much more relevant right now than we have ever experienced. And it's a good sign because for once, I think we've actually seen a real application in terms of why do we really need a type of digital currency to help the world to address some of the really leading questions out there. So yeah.
Catherine, thank you so much. You've covered a huge amount of ground there, and I just want to pick up on a couple of key things that that I took notice of as you were talking about that. One is just the research that you've done around this notion of the importance of human factors and human design. And I think as we start looking towards creating these multiple capital accounting flows that Robert was talking about and that Martin was referencing, bearing in mind the importance of those upfront human governance factors, even as we're trying to create these algorithmic frameworks, there are vulnerabilities. And I think getting that human factor piece in place speaks, I think, to some of what Robert was talking about in terms of these iwi communities, like the human level governance piece that came up on the front side as the New Zealand government was thinking about how they go about digitizing different kinds of value flows. And in particular, as we start looking at central bank digital currencies, CBDCs, how different countries approach that very complex problem of managing both algorithmic governance and the different ways that different value flows can be encoded in, the different ways that different kinds of tool sets and skill sets can be baked into these kinds of programmable currencies to manage, for example, these larger monetary issues, balancing interest rates versus flows of capital, versus these newer kinds of value flow measurement that Robert was talking about. And I think that's the difference, or that's some of the balance between the short term, the near term immediate things around potentially UBI, and as you mentioned, the US referencing in an actual bill the potential for the rollout of a CBDC, a shock to many, but maybe not so much of a shock to Robert Green, who I want to kind of just point to next, as somebody who's been looking at central bank digital currencies from the China perspective. Robert spent the last couple of years in China working with the Bank of China. I don't know how much I want to set this up. Maybe Robert, you can say exactly what you're allowed to say yourself, so I don't get you into hot water.
Yeah, so just some background on myself. I've been doing research on central bank digital currencies for a bit now, and mostly focusing on how the technology is being rolled out in China, but also in the EU, and also some of the discussions in the US. Several years ago, I actually worked on Capitol Hill on the House Financial Services Committee. So I'd like to shed some light on just kind of some of the COVID era discussions about CBDC and how this is likely to impact the situation in China and in the US. I'll start with China. For those of you who were on the call earlier this morning, I discussed, I mentioned briefly kind of the situation with Alipay and how Alipay is being is being embraced by city governments and district governments in China to roll out a health code service. And that in my view, kind of signals a preview as to kind of how you'll see CBDC rolled out in China. I think it's very interesting to see a health code system being integrated into a payments platform. It's critical to realize that Alipay is actually, part of Ant Financial, which is a financial services affiliate of Alibaba. So to see the health code platform rolled out through this private company is very interesting. And part of the reason for that is that the GPS location services associated with Alipay and WeChat Pay are better than the telecom location services. So that's what I ultimately think you'll see in China as a result of COVID is an increasing tie-in between these private tech companies and the state. And oftentimes, I think there's a perception in the U.S. that already is a very tight relationship. There's actually a lot of there's generally pushback by some of these tech players as to like what data that they would be willing to share with authorities. And WeChat has a stated policy of how it doesn't record conversations. And that all ties into, I think you're going to see, though, a change where there's going to be more and more focus on how these private platforms can integrate into the CBDC infrastructure. And just some context on that, 2-3 years ago when CBDC was first being discussed, and when this idea of two-tier CBDC, where you have the central bank kind of controlling the supply, and then you have a second tier level of banks and non-bank financial services companies. When CBDC was this two-tier model was first discussed in China, it wasn't a guarantee that these non-bank financial services platforms like Ali and WeChat were going to be integrated in that. Indeed, some of the origins of CBDC in China relate to a power struggle in a way where there's discomfort with the large role that that Ant and WeChat Pay have over the payment system. So I think one of the effects of you're going to see here in the year ahead is that Alipay and WeChat Pay have gotten a lot of brownie points. They've shown how worthwhile they are, and they will be able to they'll be trusted more with regards to the CBDC rollout. My prediction would be that there's going to be some city level pilots of CBDC within this year. My guess would be Q4. I don't think you're going to see nationwide CBDC in China this year. Going to the US, so I would not take so it's been very publicized that there was an introduction of CBDC in in one of the drafts of the stimulus bills. It's important, I think, to look at what exactly that digital dollar proposal was and how that contrasts with the digital dollar that's been discussed by former chairman of the CFTC, Giancarlo, and also some of this rhetoric coming out of the Fed. So the digital dollar proposal that was introduced with regards to the most recent stimulus bill was a partisan idea. It was introduced by Democrats on the House side, specifically the House Financial Services Committee, and in many ways resembled what has been talked about by some on the progressive wing of the Democratic Party for a while now, which is this idea of what's called postal banking. And so if you look actually at what the stimulus bill text talks about and how they roll that out, they actually integrate the USPS, U.S. Postal Service, into that CBDC network, if we're going to call it CBDC. And on top of that, there's convertibility between fiat currency and this digital dollar. So there is this provision where they're going to have, these accounts at the Fed that represent an M0, like represent a central bank liability. But it looks as if that would be an account-based system, and then the Fed would have to manage some back-end convertibility to turn that into cash. So I do think there was another part of that, though. In addition to that, the bill mandates that banks provide these limited purpose CBDC wallets for the digital dollar. So if you have a banking relationship, you could have this no-fee account that would enable you to have CBDC in the form of this digital dollar. In addition, the Fed would also have this network. I think the reason that this didn't make it into the stimulus bill is multi-tiered. One is the tech. Catherine mentioned the tech restrictions. I think this idea of converting between paper currency and CBDC adds this next level complexity that certainly spooked some people. I think also just the political dynamics, that it wasn't just straightforward CBDC. It was requiring banks to issue CBDC at effectively a loss. And that would have implications for consumer deposits, which then impacts lending growth in the midst of a crisis. I think that's another reason why it wasn't put forward. And I'll get to that in a moment, I'll just talk briefly about the alternative visions that have been set forth in the US. Another vision is Chairman Giancarlo. He was head of the CFTC until just recently. Some people know him as Crypto Dad. He's proposed basically that the Fed set up a nonprofit foundation that holds central bank liabilities on their balance sheet, and then serves as a CBDC issuer. And that would be more of a token approach in theory. There's a lot of AML, KYC issues related to that, but an important thing to note is that, you know, he's working with Accenture, and he recently has kind of built up this board of this digital dollar project. So he's taking more of a work with the Fed angle versus this other proposal was more of the House of Democrats proposal. Then finally, if you look at the rhetoric out of the Fed, it has been extraordinarily compared to other, I would say extraordinarily, but quite compared to other central banks, reserved about the idea of CBDC. There's a number of reasons for that. One is just the idea of, you know, what constitutes legal tender in the U.S. Two is that you know, the U.S. is the world's reserve currency, so anything that you're doing to affect the supply of the U.S. dollar is going to have massive ramifications on the global economy. And three is that, you know, especially in the world of interbank payments, the U.S. benefits a lot from the status quo, which is this, you know, large-scale cross-border payments that have to clear through a custodian bank, and that custodian bank is going to have relationships at the Federal Reserve. And thereby, you know, that's how the U.S. is able to exert sanction powers oftentimes, are those custodian bank relationships for interbank payments and cross-border payments. So I'll end with just making one broad comment about why I am some of my what I think is a constraint on CBDC, and that is that ultimately one of the biggest issues that needs to be resolved is that CBDC, people say, okay, this will be a cash alternative. Okay, well, the thing about cash is it's not interest bearing. It's a non-interest bearing instrument. So then what's the benefit? You know, let's take China as an example. What's the benefit of having CBDC that's non-interest bearing if you can have money in an interest bearing account and then use a very efficient payment system? I would prefer to have my money in an interest-bearing payment system, and then, in an interest-bearing account, and then use that payment system rather than just keep it in the non-interest-bearing account, as would most consumers. The other risk of having that direct CBDC is that then you'd have a negative rate environment where you, as the end user, they can pass along negative rates to you. So that's not desirable anyway. Then I'd rather have paper cash, right? If the choice is no interest-bearing versus negative, well, I want the no interest-bearing, so I'm going to have paper cash. But then it gets, what about the idea of interest-bearing CBDC? Well, the problem with interest-bearing CBDC is that that's a liabilities on the central bank's balance sheet, and the central bank can't do lending, right? And so that commercial banks, you know, the way fractional reserve banking works is they're able to, you know, take your money and multiply that into loans. So that kind of gets, there's no perfect solution there. So I think going back to China, what China's trying to do with its CBDC and through this two-tier approach is to basically have the back-end CBDC pipelines whereby you can have frictionless, low cost, and a level of government look-through ability in between the back-end transactions that are occurring between banks and occurring between institutions at which consumers have accounts. And then the functionality from the consumer's perspective is it essentially looks like nothing's changed, right? But the reality is your back end is now CBDC as opposed to funds that were being stored in a custody account. And as a result, the financial market infrastructure has become more efficient. It's easier for non-banks and banks to plug in, and the government has more ability to control supply and to surveil transactions. I ultimately think the U.S. dollar, any digital dollar approach will not take that route. I think, and you know, I can talk about that a bit more, what I think maybe the U.S. should do, but yeah, I just wanted to set forth that kind of view on the constraints that are, I think, in the short term, going to really impede the ability of CBDC to be rolled out.
Robert, thank you so much just for laying that out. I mean, your definitely, I think, one of the few go-to people in the world who are actively in the midst of both the Chinese and the US CBDC programs and projects. So offering that comparison is really helpful and useful. I mean, I think a lot of these questions around how they actually get rolled out, and you were talking about city level pilots, for example, I think speaks again to this this notion of how do these different pieces end up working together. Robert, I kind of want to throw it back to you, just as we've got a few more minutes until we're going to take a break for lunch for those in California. But I mean, when we start thinking about these smaller scale projects, whether it's, you know, in a smaller country or smaller localities that are, you know, piloting, they may be tracking conventional value, they may be tracking alternative measures of value. What are some of those, I guess, fundamental pieces around how these end up working together that you feel are necessary from I guess, initially from your technical perspective, and then maybe we can just, you know, have a quick reflection on that sort of the legal and the governance piece as well, because I think Catherine spoke to some of those human factor approaches that she's seeing being put in place for these stablecoin projects, and obviously those feed into it. But Robert, you know, having seen these different multiple value flows for the data commons in New Zealand, yeah, would love to hear your thoughts on that interoperability piece.
In what, 3 minutes?
Yeah, well, I mean, we have until 1:30 for the next formal session, so we run over.
Okay, so interoperability, the main gist really from the data commons perspective, and certainly what we were bringing was this idea of interoperability was really kind of at the core of it, and that you needed both the technical layer, but also a social, economic, and political layer. Set of protocols. So you can imagine there's sort of a series of protocol stacks, not just in the technical sense, but also in the legal governance sort of sense of protocols and how we handle things. One of the big things here was, and it was touched on with, say, like the data in the session 2 on COVID sort of work, is the provenance of data. One of the big things now that we've got an issue is that because it's pretty much easy to create any sort of data set or present what you're doing with data, and it looks legitimate, but we have no real idea. The veracity of where the data came from was a really, really key part of all of this. So hence that sort of loops directly back into the notion of digital identity, not just identity for individuals, but this also ties into identity of machines at the edge, or machines in general, identity of computations, identity of documents in the sense of data sets, whatever you're coming through. And that each of these things has a life cycle that it may go through, may evolve over time. So the notion of digital provenance is really kind of one of the key things to interoperability. And tied with that is the notion of identity, and therefore you land in sort of space like the self-sovereign digital identity space and distributed identifiers and verified claims. So a lot of the self-sovereign identity work was really quite pivotal to this, in particular the notions of verified claims, because I can produce a data set, but I need to say, this has come from here. This is what I've done. And another key aspect to the data commons, it isn't about making data available per se, it's about making the reuse of the data applicable. So i.e. sort of interoperability. So because in fact there's really no single source of a data point, in order to be useful, data gets aggregated or integrated with other sets of data to inform us more broadly. So, so digital provenance, which is tied to identity, and therefore also you've got considerations about privacy, or from a commercial standpoint, commercial concerns as well, which is, you know, a good example of what we were looking at in the data commons was being a country of 22 million cows that are largely grass-fed. We also have a immigrant from Australia called a possum, which is doing a lot of damage to our biodiversity, but also carries TB. So reporting on possum counts and the tracking of TB through those possums, etc., is actually really commercially sensitive. And farmers are very reluctant to actually report those numbers because it can have a significant impact on their land asset values, as well as their social pressures, as well as the acceptance of their milk profitability generally. So that's an example where there's commercial sensitivities about something you wouldn't even thought about. Possums themselves don't really care on that side of things. So the other aspect I think was for interoperability was really taxonomies, ontologies are really, really important. You know, the semantics of the data and how we convey that in a portable way was is really quite a key point of that. So a lot of the stuff we were looking at was within the semantic web kind of components, open data and linked data type of things going on there. Because essentially what we're talking about in terms of interoperability is creating a pipeline that data flows through. And at each stage it's getting aggregated and new data form or new information is being pumped out the other end. And that is essentially systems integration. So we have to make those data sets machine readable, machine interpretable as much as anything. So those are just some of the factors. And then you've got the backward flow because the data is being reused at different points. How do we redistribute value disbursements going back the other way? And again, that's just another data set going the other way. I don't know if that answers your question.
Oh no, it's perfect, Robert, and that takes us nicely to the top of the session. I want to give a massive thank you to Catherine, Robert, and yourself, Robert, just for giving us the overviews of your personal work. And I think that this is a huge topic. Going back to the previous session, I think it does have these huge coordinative potentials when we're talking about these urgent responses as well as these longer term issues that are around common good. I think to this point around COVID, climate data, where's this setting us up? I think this notion that, this is an invisible enemy, but this is a common enemy. It's one that we're all facing together for the first time. And so that notion of coordination is more pressing than ever. So from both the legal, the governance, the human, the leadership, and the technical side of things, bringing this together through these kinds of discussions, and then hopefully prototyping and informing through those prototypes some of the decisions that policymakers are making, potentially in variously different incentived environments. But these are all things that we're trying to bear in mind. So with that, I kind of want to give. Yeah, go ahead, Robert. Go. Yeah,
adding a little bit here is sort of within terms of the session, the way I view sort of money and currencies and stuff, and indeed more the higher level abstractions such as accounting and finance, is they're all coordination technologies. Fundamentally, they're about helping us interoperate and work together. And largely a lot of the stuff that we are used to thinking about from a policy point of view or systems design point of view have largely been anchored in systems that were paper-based, more tangible, etc. Obviously we're in a new era where we can actually think of systems in a more digital form and the implications of what that means to create interoperable systems that are digitally native rather than manifestation of what we've done in the past in terms of paper-based forms. So that's how I view a lot of the work around all the distributed ledgers sort of work, blockchains, etc. Is it's fundamentally a coordination technology to help us act together and to interoperate. I'll leave it there.
Beautiful. And I think that's why we lawyers and accountants and folks who care about coordination and the commons, nurturing the commons, I think that's why we've, from that perspective, there's a lot of us who've been looking at both digital ledger technologies and the sorts of things that they enable, like digital currencies and tracking different kinds of value flows, including things like biosphere health, local community health, and other things like that. So thank you again, everybody who's been contributing. We've got programmed in a break now for now 55 minutes.